Did you know that if you borrow $500,000 over 30 years with a 5% interest rate, you don't pay back $500,000. You actually pay back around $966,000. So that extra $466,000 goes to the bank. So that's why I wanted to share in this video some ways to pay off your mortgage faster that could shave years off your mortgage and also help you build wealth at the same time. We'll be going through offset accounts, making extra repayments, investing your money instead of paying down your mortgage, and at the end of this video, we'll be summarizing each of these strategies and giving the pros and the cons. And I'll also be sharing what I'm personally doing. So by the end of this video, you'll have more information about which one works for you. Keep in mind that anything we talk about in this video is general advice only and not personal financial advice. You can read my full financial services guide in the description. So sit back, relax, grab a drink of your choice. Today I'm drinking hibiscus flower tea, and let's jump into it. So first, let's talk about how mortgage interest rates actually work. When you first get a mortgage, most of your repayment isn't actually paying down your home. It's going to interest. As you can see here from this table, in the first month, let's say for example, you have a $500,000 mortgage with a 5% interest rate over 30 years. The monthly repayments would be $2,685. And we can see here from this table that in the first month, $2,083 of that repayment is actually interest, meaning only around $600 is actually going to paying off your home. But over time, as your balance goes down, more of your repayment actually goes to paying off your home. But if you fast forward to year 10, your balance is now $406,000 and $1,698 goes to the interest. So at the 10-year mark, you're paying roughly 63% interest and 37% principal. And 20 years in, the interest payment is even less. In year 20, your balance would be $253,000 and $1,061 will be going to the interest and the rest would be going to the principal. So to recap, even though you're paying the same monthly repayments, in month 1 it's roughly 78% interest and 22% going to the principal. 10 years in, 63% is interest versus 37% principal. And 20 years in, only 40% is interest and 60% is principal. And if you're looking to get on top of your finances this year, the app that I use to track my spending and do all of my budgeting is called Bilru. I love this app. We've been working on it for the past few years with our team, and it's honestly amazing to see exactly where my money is going. I literally use it every day to check in with my finances and just make sure that I'm spending money on the things that bring me value. There's also a really cool AI feature, and I love using it to just chat about how my spending's going, how my budgeting's going, and if there are any things that I should be mindful of. So if you'd like to try it for yourself, I've got a link in the description below to a 14-day free trial. So the first strategy is to switch to weekly or fortnightly repayments instead of monthly. And the reason this works is because interest is calculated daily. So the earlier you make repayments to your home loan, the less interest is charged. And if you switch your payments from monthly to weekly, you may be able to chip away at your loan quicker by repaying slightly more to your home loan each year, but without really feeling it. I know this sounds a little bit confusing, but here's how it works. Making your repayments weekly instead of monthly feel like the same thing, but if you basically take your monthly repayment and then divide it by 4, you'll actually end up making one extra repayment per year because there are more payment cycles. So let's say, for example, you have a $500,000 mortgage with a 5% interest rate over 30 years. And your monthly repayments are $2,685. That means after 30 years, you would have paid off your home loan and you would have been charged $466,000 in interest. But here's where it gets interesting. Let's say instead of paying $2,684 per month, you pay $670 per week instead. That means you would have paid off your home loan 4 years and 9 months earlier, and you would have saved $86,000 in interest. And here's how it works. Even though paying $671 per week seems the same as $2,684 per month, by paying $671 per week, you're actually making the equivalent of 13 monthly repayments per year instead of 12. As you can see from this example, $2,684 times 12 is $32,208, whereas $671 per week is actually $34,985 per year. Because there are technically roughly 52.14 weeks in a year. So in this example, you're technically paying $2,700 extra per year. So the two main reasons why you'd be able to pay off your mortgage faster by switching to weekly payments instead of monthly payments is mainly because you'd technically be contributing $2,700 extra per year, and also because interest is calculated daily, you'll be increasing the frequency of your payments. So therefore, less interest would be charged. So if you're looking to set something like this up, here are some important things to do. First, it's important to know what kind of loan you're on. If it's a principal and interest loan, that means that you're actually paying down your loan over time. But if it's interest only, you're not. The second thing to check is the fees. Some loans do have extra rules around extra repayments, redraw, or refinancing, and they could even have break costs. The third thing to do is to keep a buffer so you're not stressed. So instead of using all of your money to pay off your mortgage as quickly as possible, it's important to still keep a cash buffer just in case any unexpected emergencies pop up. It's recommended to have from 3 to 6 months of living expenses saved in cash in a bank account. And if you have checked all of those things and you're all good, you can then call your bank and ask them to implement any of these strategies. So the next strategy is one of my favorite strategies, and that's using an offset account. I honestly wish I knew about the benefits of having an offset account earlier, because that means I would have gotten an offset account way earlier than I did. But you live and you learn, I know now, and hopefully some of you will learn something new as well. So an offset account is basically like a bank account which is linked to your mortgage, and any money that sits in your offset account basically offsets the interest that you pay on your mortgage. So let's keep the same example. Let's say you have a $500,000 mortgage with a 5% interest rate over 30 years. And let's say you have $50,000 in emergency savings that you can keep in your offset account. That means that even though you still have a loan of $500,000, because you have that $50,000 sitting in your offset account, the bank will now only charge you interest on $450,000 instead of $500,000. And with a 5% interest rate per year, that means that this money sitting in your offset account is saving you around $2,500 per year in interest. And one of the really amazing benefits of using an offset account instead of a high interest savings account is you don't need to pay tax on the interest that you save with an offset account. Whereas if you have that $50,000 sitting in a high interest savings account, you do need to pay tax on the interest that you earn through the bank. Because when you're saving money in a high interest savings account, you're earning interest from the bank. Whereas when you have the $50,000 in an offset account, you're not earning interest, you're saving interest, so you don't need to pay tax on it. And the crazy thing about offset accounts is you basically save as much interest as if you were to repay your home loan faster just by having that money sitting in your offset account. Let me explain. So if you keep $50,000 in an offset account consistently and your rate stayed the same at 5% per year, and then you kept paying the normal repayment amounts of $2,684 per month over a 30-year loan. If you didn't have that $50,000 sitting in an offset account, that means the total that you would have repaid over 30 years would be $966,000. But by having the $50,000 sitting in your offset account, then the total repaid would only be $824,000. That means after 30 years, you would have saved $142,000 in interest, and you would have paid off your home loan 4 years and 4 months faster. So here are some benefits of using an offset account and some things to be mindful of. So the first benefit of using an offset account is they're tax-free. If you had that $50,000 sitting in a high interest savings account, you would be earning interest from the bank, which means you would need to pay tax on the interest that you earn. Whereas when you have the $50,000 sitting in your offset account, you're not earning interest, you're saving interest. So therefore, you don't need to pay tax on it. Another benefit of keeping this money in your offset account is it gives you more flexibility. When you're making extra mortgage repayments, it's really difficult to try and get this money back out from the bank. Whereas when you have this money sitting in your offset account, you can basically take out that money whenever you like. And the third benefit is it has the same benefit of actually paying off your mortgage faster, but it just gives you that extra flexibility. If you paid an extra $50,000 to your mortgage, it would have the same net benefit as putting $50,000 in an offset account, but you get to keep that flexibility of being able to use that money whenever you like. So now we know more about the benefits of using an offset account. Here are the things to be mindful of. The first one, which is something that I've personally gone through, is it can be really easy to access these emergency savings, especially if you only have the one account where all of your bills are paid from. This is something that personally happened to us. We had our emergency savings in our offset account, but then we also used that offset account to pay for all of our bills bills and everyday expenses, and that meant we were actually depleting our savings without really being super mindful of it. So now instead of having the one offset account where all of our bills come from, we basically set up another offset account just for our emergency savings, and we basically keep this emergency savings offset account separate to the offset account where all of our everyday transactions come from. So that means we know for sure we're not overspending and we're not dipping into our emergency savings unnecessarily. And that's why I personally love using a bank that allows you to have multiple offset accounts. Some lenders actually allow you to have heaps of different offset accounts, and I find this works a lot better for us because I find that I'm not tempted to spend the money in my offset account, especially when it is separated like that. So the next strategy is making extra repayments. Even small amounts of money add up crazy over time. Let's use the same example of having a $500,000 mortgage over 30 years with a 5% interest rate. Your repayments would be $2,684 per month. If you add an extra $50 per week, that means you could pay off your mortgage 4 years and 7 months earlier and save $82,000 in interest. If you add $100 per week extra, you could pay off your home loan 7 years and 10 months faster and save $139,000 in interest. And if you add $200 per week extra, you could pay off your home loan 12 years and 3 months faster and save $211,000 in interest. So what seems like a small amount of money can add up to big things later on. Instead of making smaller weekly repayments, you could instead choose to do lump sum payments instead. So let's say you get a tax return or a bonus. Let's say you put $10,000 into your loan early on. If you do it right at the start, you could save $33,000 in interest and pay off your home loan 16 months faster. But if you do it 10 years later, you'd only save $16,000 in interest and you'd only pay off your home loan 9 months earlier. But before you do start making extra repayments, it's important to double check with your bank, especially if you are on a fixed rate, that there aren't any extra fees for repaying your mortgage earlier or even extra repayment caps or potential fees or break costs. The next strategy is refinancing or negotiating a better rate on your mortgage. This one, in my opinion, is pretty underrated because it just seems boring. But even a tiny rate drop can add up to tens of thousands of dollars over the lifetime of your home loan. Let's say if you manage to negotiate a 0.5% reduction in your mortgage interest rate, so going from 5% to 4.5%. The baseline 5% interest rate would mean that your monthly repayments are $2,684 per month. This means over the life of your loan, you would have repaid $966,000 and you would have paid $466,000 in interest. But if you manage to refinance your home loan at 4.5% per year or negotiate a better deal on your existing home loan, that means your new rate would be 4.5% and your new monthly repayment will be $2,533 per month. Over the life of your loan, that means your total repayments would have been $912,000 and the total interest would be $412,000. So that means you'd be saving $54,000 and most of that would be interest. Another option would be to refinance or negotiate a better home loan rate at 4.5%, but you keep paying the older higher amount as if nothing has changed. So you keep paying $2,684 per month. That means you'd repay your home loan 3 years and 3 months faster, and you'd save $106,000 compared to option 1. But here are some really important things to keep in mind before you do refinance or negotiate a better deal on your home loan. First is that refinancing can come with extra fees. So make sure you know about any of these fees upfront so you can make a decision as to whether it's right for you. Another important thing to note is check with your bank and your current lender to see if there are any break fees. And it's important to weigh up any of these fees to see how much you could potentially save over the long run to see if it's worth it or not. Another thing to be mindful of, and this is something that I honestly wish I knew earlier when I was getting my first home loan, is mortgage brokers could be a good option, especially if you are looking to refinance or get a mortgage, because they're basically free for you and I to use, and the way that they get paid is the bank actually pays them a commission and it comes out of the bank's commission. So we essentially don't have to pay for mortgage brokers because the bank pays them a commission and that comes out of the bank's interest. And they can help you navigate the whole world of mortgages and help find a bank and a lender that could be right for you. So one thing to be mindful of, especially if you did go through a mortgage broker initially, is if you decide to go with another bank, the mortgage broker may have to pay back all of the commission that they earned from the bank. So if you are looking to refinance or get onto another home loan, it's a good idea to call your existing mortgage broker and see if they can negotiate a better deal for you, rather than doing it yourself. And if you are looking to refinance or potentially go with a mortgage broker, I have put a link in the description below so you can book a call with a mortgage broker and see if it's right for you. And the final strategy to pay off your mortgage faster is by investing instead. This is where things get spicy, and this is what I'm personally doing. Let's say you have a $500,000 mortgage with a 5% interest rate over 30 years, and you have an extra $1,000 that you could use to pay down your mortgage faster or invest. If you choose to make an extra repayment of $1,000 per month, that means you'd be mortgage-free in 16 years and 9 months instead of 30. That means you would have saved 13 years and 3 months, and you would have saved $227,000 in interest. And now you can use that extra $3,685 monthly to invest in the stock market. But here's where it gets interesting. Since you have already paid off your home loan, you now have $3,685 that you could use to invest or spend on whatever you like. Let's say, for example, since you have already paid off your mortgage, you decide to invest the $3,685 per month for the remaining loan term. So you invest $3,685 monthly over 13 years with an average annual return of 8% per year. That means after 30 years, you'd have a paid off home and around $1 million in investments. But that's not all. Let's compare that to investing instead. Instead of using the $1,000 to repay your home loan faster, you just make the minimum monthly payments of $2,685. Let's say you invested that $1,000 per month instead of using it to pay down your mortgage. After 30 years with an average annual return of 8% per year, you'd have around $1.49 million in investments and a paid off home as well. But here are some important things to keep in mind. Taxes apply when you sell your investments for a profit, so these calculations didn't include that. Also, when you repay your home loan faster, you're getting a guaranteed return on your money because you're guaranteed to save interest. Whereas when you are investing that $1,000 per month, I did use an average annual return of 8%, but the average annual return for the US stock market is approximately 10% per year, and the average annual return for the Australian stock market is around 9% per year. But this is just an average based on the past performance of the stock market. This isn't a guarantee. So investing wins in this example mathematically and on paper, but some people just prefer the security and peace of mind that paying off your mortgage faster gives you. I personally have some friends that are fully comfortable with investing in the stock market, but I also have some friends that don't invest and just prefer to pay down their mortgage faster. So this really just depends on what you prefer to do at the end of the day. So if you're someone who hates debt and wants guaranteed progress, potentially paying down your mortgage faster or getting an offset account could be a good way to go. But if you're someone who likes investing and has a long time horizon of more than 10 years or more, and you have a steady income and you don't panic when the stock market falls, then investing could also be a good option. Or maybe you prefer to do a bit of both. I personally have an offset account, which is where I keep my emergency savings. I've also switched my mortgage repayments to weekly instead of monthly, and I do contribute slightly extra, but with the rest of my money, I prefer to invest it. So you could do a bit of a combination. It all depends on what works for you. So here's a recap of the 5 different ways to pay off your mortgage faster. The first way is to switch to weekly payments instead of monthly or fortnightly. Since interest is calculated daily, you do save slightly more money. And if you decide to get your monthly repayment and just divide it by 4, you'll basically be sneaking in an extra repayment each year, which will also reduce the interest paid. The second way is to use an offset account. Offset accounts basically offset the interest that you pay on your mortgage. So if you have a $500,000 loan and you have $50,000 sitting in an offset account, then you'd only be charged on the interest of $450,000 instead of $500,000. The next way is to make extra repayments. Even an extra $50 a week can add up to a big amount over time. You could also choose to refinance or negotiate a better deal on your home loan. And finally, you could also choose to invest instead of repaying your mortgage faster. One of the best things that I've ever done with my finances is actually sitting down and tracking to see where my money is going. And if you're not quite sure what to invest in, I've made quite a lot of videos on this channel just breaking down different ETF options and different investment options, so you can check them out here. I used to use spreadsheets, but a few years ago, my partner and I, we co-founded this company called Bilru, and And it's basically a budgeting app and a spending tracker that can do this automatically for you. I love using it to see all of my expenses in the one place, even though sometimes it can be quite daunting, seeing just how much money we've spent on certain things. I also find it incredibly motivating, and I feel like it also helps me make better decisions in the future because I'm a lot more mindful of exactly where my money goes and also where it's coming from as well. There's also an AI which I love talking to get insights about my spending and also to get some things that I should be mindful of or some areas that I should be looking into. So if you want to try it for yourself, I've got a link in the description below to a 14-day free trial. Thanks for watching this video all the way through. Your secret word is banana. So write us a comment below with the word banana in it just so we know you watched this video all the way through. Thank you. Bye.